Hi, everyone, and welcome back to the Nick Halaris Show. Our guest this week is Frank Rohde, the founder and CEO of Ownify. Frank, welcome to the show.
Thanks for having me, Nick. Excited to be here.
Yeah, I came across your company several weeks ago in one of the many real estate newsletters that I've been reading and was instantly intrigued. I've been podcasting a lot and writing a lot about the American dream and the housing affordability crisis, and have had several entrepreneurs on the show already who are attempting to make a difference for Americans on this stuff, and really excited by kind of your vision. So I think the best place to start is, why don't you tell us what you're up to?
Okay. So Ownify is really focused on creating an on-ramp for first-time homebuyers, and in particular, folks who I would call the missing middle, right? People with decent incomes, good credit, but folks who haven't been able to save for the down payment and are competing against, cash buyers and repeat buyers and everyone else out there in the market, and are struggling to get their foot in the door onto the property ladder. So what Ownify is really an on-ramp for first-time buyers that allows them to jump over the down payment hurdle and get in the market sooner, start building equity, start enjoying all the benefits of ownership. And the backstory to this is that I spent 15 years in my prior company running a company called Nomis as CEO. I started that company, built it, ultimately sold it. And in that company, we built the pricing engine for a lot of the large mortgage lenders in the US and Canada, abroad. So I spent a lot of time in the bowels of mortgage math and really getting deep into how that product works. And as part of that, also saw in the data that more and more people were struggling. And I think everyone kind of knows that story anecdotally. You hear it, circle of friends and family, and you read about it. We're turning into a nation of renters. But I saw this in the data that more and more first-time buyers are getting squeezed out. And so that was the impetus about 2 years ago to start Ownify and really build a product that can help solve that problem for aspiring first-time buyers.
So I want to ask you about that mortgage data stuff, but before we get into that, let's get into how does Ownify work? Like, what are the mechanics of helping somebody in this missing middle or this first time home buyer space?
Yeah. So the question we asked at Ownify is there a different way to buy your home than the traditional way of borrowing a lot of money through a mortgage, putting a down payment down, and then paying off that mortgage over 30 years? And so what we've built with Ownify is really a co-investment partnership or a fractional ownership structure that allows the first-time buyer to pick a home, and we will buy that home on behalf of that buyer, structure an investment partnership, and effectively partner market rate investors with that individual to purchase the home. And so for the ONI, as we call the customer, the buyer, what that means is we can get them started with 2% down payment, significantly lower than most mortgage offerings out there. They don't have to worry about closing costs or buyer commissions or any of the other things that usually add to the purchase price. We can guarantee a 5-year fixed payment over the first 5 years, during which they live in the home, build equity. And the way that product is designed and the way the math is structured is that you work your way from 2% to 10%. So you buy equity every month through that fixed payment. And once you have 10% at the end of 5 years, you can use that as the down payment for a traditional mortgage and buy the home from the investment partnership and own it the traditional way, with the mortgage and pledging the title to the mortgage lender. If that's what you want to do. If you want to just stay in the program and, continue on after 5 years and renew for another 5 years, you can do that as well. So during those 5 years, fixed payment, 2% down, affordable payments today lower than a mortgage. We take care of insurance and property taxes and maintenance and repair. So one of the big benefits to the first-time buyer is no surprises, right? You don't have to worry about the water heater needing replacement or the roof leaking, and all of a sudden you're on the hook for a big check. So we take care of that kind of home ownership cost. And then importantly, because of the way this equity partnership is structured, we guarantee, or the structure guarantees that the customer can't be underwater. So they're building equity, but they they don't have a mortgage balance, right? And there's no way for the customer to ever be underwater or owe more on the home than it's worth because there is no debt involved. So that's the basic structure. It's an equity-based way to buy the home rather than a debt-based path to ownership.
That's really cool. Okay, so just to keep round numbers too, I just want to make sure I understand it. Let's say there's a $500,000 house. Customer identifies it, that they're interested in living in it. It goes through some kind of review at Ownify, like, hey, that's a decent price. So you're not overpaying or something like that. And then they purchase it, or this partnership purchases it in the name of what, like a LLC, or how does title held?
Correct. Yeah, exactly. So you're in real estate, so you'll appreciate this.
Yeah.
What we're doing is we purchase the home. So let's take that $500,000 home that you described. We put it into an LLC, and that LLC issues 10,000 shares or membership interests. And we call them bricks, right? So each share is equivalent to a brick. And on day one, when you purchase the home for $500,000, 10,000 bricks, each brick is worth $50. And so the way the payment program works is that the customer makes a fixed monthly payment, and a portion of that payment pays rent on the bricks that the customer hasn't purchased, right? So on day one, that's 9,800 bricks. And a month later, that number goes down. And another portion of the payment buys incremental bricks every month. And so the way to visualize this is that the customer starts with 200 bricks and they're stacking their bricks over time, which means the portion of the payment that goes towards rent, or the rent that the customer has to pay, goes down over time. So it's not debt, it's not a loan, it is a fractional ownership and fractional rental arrangement where the customer rents the portion of the home they haven't bought. And once they purchase the bricks, right, the portion that they own, they don't have to pay rent on.
Okay, got it. And what's the deal in year 5? Like, is there a set purchase price determined, or is it market based?
It's market based. And the way, again, this is equity. The way this works is that every month we value the home. So that $500,000 home, we close on it, let's say for $500K on day one. A month later, it might be worth $501,000. And that means that the bricks are sold or transferred at that point for $50.10, right? Again, 501,000 divided by 10,000. So the brick price went up a little bit. Let's say a month later, the home is valued at $499. Now the bricks are worth $49.90. And so every time the customer makes a payment, they're buying bricks at the then current market value. And if you think about what that means, it's similar to buying mutual fund shares or any other equity over time, where you're effectively dollar cost averaging. That means on the dips, you're buying a little more. On the peaks, you're buying a little less.
Yeah.
And over time, that kind of averages out the purchase price, right? And so picture that, you do that every month for 60 months, for 5 years. At the end of 5 years, to your question, there is a walk of prices, right? There's a line that you can draw to say every month you've bought these bricks at some purchase price. Well, your purchase option to buy the remaining stack of bricks is always at the then current market value, right? So if in that month, I might have paid $52 or $53 or $54 per brick, that is now my option strike price to say I can buy the remaining bricks at that current market value. So for the customer, there is the appreciation on the bricks that they've built in. And for the investor pool, there's appreciation on the bricks that they're holding, right? And that's really what makes the math work and what creates return for both sides, is to say to the investors, you can participate in home price appreciation. You're also getting rental return on the fraction of the home that you hold over time. And because of that return, we can lower the upfront cost, right? We can make it more affordable for the customer to come in with 2% and then pay a fair, affordable monthly payment.
And how do you calculate the monthly payment?
So the monthly payment is really set based on market rental rates. So if you take the equivalent home and look at what is that home currently, or what would that home command in terms of rental income or rental rates, right, in the market. And what we then do is we look at the market rental rate. We fix it over 5 years, which means you pay a little more in the early years, you pay a little less in the out years. But then that rental yield is applied only to the bricks that you haven't purchased. So really what that means is that over 5 years, over time, the rental payment goes down as your equity, your stack of bricks goes up. And that's very different than any other rental payment out there, right? Because one of the biggest fears, and quite frankly, one of the biggest drawbacks to renting is that landlords can increase the rent every year, right? Depending on the market you're in. And that creates uncertainty and risk and annoyance, quite frankly, for renters. And we hear this all the time. So
Yeah.
we are pegging this to the market rate, but we're fixing it over that 5-year horizon.
Okay. Very cool. And where are you guys operating? Like how big are you guys at this point?
We're very early. We launched in Raleigh, Durham, North Carolina. We're now in the rest of the state. So Charlotte as the other big metro area, Fayetteville, a couple of other markets. And we're about to launch Nashville, Tennessee as the next market. And then looking at other markets kind of towards the end of this year, early next year. So really a regional kind of a rollout. Ultimately, we want to be nationwide, but we're being very smart about kind of which markets do we tackle to prove the concept, right? Prove the viability, get investors on board, get first-time buyers on board.
Yeah, definitely. And the 10% like deal for the customer, let's say they accumulate this money. Essentially, do they just have a contract with Ownify that says like, let's say 10% added up to be, what would that be? 50K in this example.
Yeah.
Is that sitting in a bank account waiting for them to use it as their down payment, or is it just a contract, a deal with Ownify?
It's an investment in the LLC. So the way legally, structurally this works is that the customer at that point, let's say 5 years from now, owns 10% of the LLC. So it's a private investment in shares or membership interests in a limited liability company that holds title to the home that you live in. So if you think about it, it's a unique structure in the sense that the customer, on the one hand, is a tenant or a renter of a property that is owned by a limited liability company. And at the same time, that customer is also a shareholder of that landlord, right? And that structure actually exists today in New York City for co-op buildings, right? Where people who live in a co-op technically own a fraction of the corporation that owns the building.
Yep.
We've just applied it to single family homes to say, you can own a fraction of the entity that holds title. And the reason we did it that way is that today in the US, you cannot fractionalize a title. It's very, very difficult. I mean, it's impossible basically to say, I'm going to fractionalize a title between, a person living in the home and then a pool of investors. And so rather than doing it directly to the title, we're putting the title into this limited liability company, and then we're issuing shares in that limited liability company. So to answer your question, at the point where the customer wants to buy the home outright, they're effectively selling their interests in the LLC back to the investor pool, and at the same time buying the home from the investor pool, right? And that's how that transaction ultimately resolves itself, because the value of the LLC shares is effectively 10% of the purchase price of that property.
Yep. And last question on the mechanics: how do you determine the value every month?
So we use 3 different AVMs, or automated valuation models. So those are all large companies that do this for a living, and they've gotten pretty good. There's always going to be some amount of error, but because we're using 3 different ones, we can kind of average out any sort of random fluctuation or potential error. And because we're transacting a very small fraction of the home in any given month, right? If we're a little too high or a little too low in any given month, it doesn't really matter.
Yeah.
So that's the valuation mechanism. And the reason we did it that way is that becomes a fair third-party assessment rather than Ownify determining the value of the home or the Oni determining the value of the home, right? Where you get into an argument. We're basically saying, look, let's use third parties who do this for a living.
And it's not Zillow or Redfin, right? It's like...
It's not Zillow or Redfin. Yeah, no. I mean, those are always interesting, and consumers look at them and say, "Oh my God, look at how much my house is worth," right?
Yeah.
But they're not necessarily I don't want to assail them, but there's other ways of establishing value pretty accurately.
Yeah. It's funny, people do get anchored on those estimates and stuff, but they're not really all that accurate.
Right.
Yeah. Fascinating. Well, I feel like this sort of business model that you guys are pursuing is attacking sort of the main pain point in America. Like I was actually talking to my parents this week, and they were in town, and they were explaining their first time home buyer experience. They came of age in the era when interest rates were like 17%, when short term
Right.
interest rates are 17%. And so they were telling stories about how they had to ask their parents to borrow money for the down payment. And the down payments were substantially higher because the rates were so high you could barely afford any mortgage at all. But
I mean,
that's the problem in this country is nobody has enough money to buy these houses.
yeah, and if you think about it, so I did the same thing, right? I came here from Germany, worked for a couple of years, eventually had a good income. I was living in San Francisco. I wanted to buy a condo, and I didn't have enough money for the down payment. So I asked my parents, and they helped me, and that was great, right? And that was a number of years ago, but it stuck in the back of my head as, why isn't there a market-based solution for this, right? Now, the market-based solution that eventually the market came up with were 0% down payment mortgages. And the issue that we had with those is that you don't have incentive for the customer to take care of the home, right? As soon as home prices fall just a little bit, you have this problem of negative equity. Someone is underwater on their home. And we saw what happened with that in 2009, 2010, 2011, where people were sending keys back to the lender saying, I'm not going to pay a $400,000 mortgage on this house that's only worth $300,000 now. So there's a moral hazard built into this low down payment mortgage, which is one of the reasons we built this as an equity structure, right? Because you own 2 or 3 or 5% of something, even if that something goes down in value, your 2 or 3 or 5% is still worth a big chunk of money, right? But the bigger problem, I think, that we're talking about here is, you think about your parents or maybe yourself or myself, right? We all had the background of family with enough resources to be able to support people. And if you look at statistics today, 50% of first-time buyers get help from their parents, which is great if you have parents, right, with enough money. But what about the other half? What about the folks who don't have wealthy parents, right? Those folks are really shut out of the housing market. And when you dig in and you look at why is that, well, first of all, house prices keep going up. The reason they keep going up is that we're short housing, right? There's not enough supply to meet the demand in the country, whether it's, single family homes in particular, but condos, ownership units. So you have a shortage of housing. We're not building enough. Second thing that's happening is mortgage rates have gone back to where they're probably going to be. And if you look at the long run average over 50 years, the mortgage average is about 5.25, 5.5, right? They're at 7 today. They're going to come down a little bit, but we're not going to see 2.5% rates or 3% rates anytime soon, right? So payment affordability is harder than it was 3 and 4 years ago. Then you have basically cash buyers competing. You have private equity investors, Wall Street investors coming in, buying up single family homes, turning them into rental properties. So as a first-time buyer, even if you can get a mortgage and you can qualify and maybe you got some help, you're competing against cash buyers, right, who are very aggressive out there. And then you have effectively a regressive or tax policy that no longer allows you to deduct mortgage interest from your taxes if you're a first-time buyer, right? Because as a first-time buyer buying a $300,000, $400,000, $500,000 property, you're not itemizing your taxes, right? On a $120,000, $140,000, maybe $150,000 household income. You're taking a standard deduction, so you're not benefiting from that, what used to be a historically kind of a wealth transfer, right, back to homeownership or a subsidy for homeownership. So all of these things are coming together. Oh, and the last one I forgot is most first-time buyers today have student debt, right? So rather than being able to save a chunk of your income out of your first couple of paychecks, you're paying back student loans for 3, 4, 5, 8, 10 years, and that delays the ability to save for that down payment. So all of these things are coming together, and that's what we saw in the data. Say, someone needs to build a solution here to help first-time buyers get into the market.
Yeah. And I really believe in that. I feel like being in real estate these last 20 years, I've dabbled in different strategies, but mostly in almost exclusively in apartment buildings and houses. And over that 20-year period, there's one thing that stayed the same, which is the most reliable demand out there in the entire real estate world is people want to buy a house that they can live in. That's
Yeah.
what people want in America.
Yeah.
And there's all kinds of thought out there that there's all these renters by choice. But the truth about it is that nobody really wants to be a renter. Everybody wants a piece of America, and there are good reasons for it. That list that I want to go through that list, actually, you listed about 5 things, the reason why housing is out of reach for people. Well, what that means, if you're one of the lucky, like let's say you're on the other side of the ledger, the 50% side that your parents can help you, it materially improves your financial picture. Almost in every case. It doesn't always, because you could like buy at the wrong time, or you could buy at a time and then be forced to move because of a job relocation. It's not a guarantee, but you really set yourself up to have a much better net worth picture if you fall in that other bucket of people. You fall on the 50% side. And that's really true in a place like California, where prices got out of control. Like you can become a millionaire in California just by buying your first house and sitting on it for 10 years or something like that. And it's probably going to appreciate significantly. And so it's the country's kind of gotten skewed on this one dimension of like, do you own a home or not? Or can you get into this pool? And if you can, life is great and your financial picture looks better and better. And if you can't, then you're angry.
Yeah. Yeah. I mean, financial wealth creation, right, and appreciation, equity appreciation is a big driver. And you're absolutely right that the single largest source of wealth in the US for the majority of people is their home, right? More than anything else, more than stock market investments or other savings. So that's a big driver for people to get into the market. But I think there's a big emotional aspect, right, and an aspect of kind of mental health and security, and the notion of living in a home where no one can tell you to get out, right? No one can raise the rent on you or make unreasonable demands on you as a tenant. And one of the things that I remember when the kids were little, right, we were able to, in their bedroom, put little notches in the door jamb, right? Which, I mean, you could do that in a rental home, and then eventually you're going to get charged for the property destruction, right? But the simple notion of every time I see that, I was like, oh yeah, the kids were little, now they're taller. My son is 6'6" now. He's like the very top of that door jamb. But that's that kind of little thing of being able to do that, right, and staying in the home for that long, and having the ability to make that space your own, right? That is really valuable, right? And we see this with our customers when we talk to folks, especially the ones who are starting families or starting out with young children, right? They want that security and that notion of, this is our space. This is where we're going to raise our children, where we're going to do the things we want, right? And that's important. That's, I think, a big part of the emotional component of home ownership, right? In addition and separate from the financial aspects.
Yeah, it's a great point. And it goes beyond just things like that, like the human stuff. It goes into the democratic function as well. One of the things that I've noticed is that when people do get into the home ownership, class, whatever we want to call that in this country, they tend to care a lot more about what's happening in their community. And there's a direct relationship, in my view, and just my limited, data set, between whether you own a place in your neighborhood and whether you participate in local government or not. And that's
Yeah.
really important.
Yeah, I think it's democratic participation. It's taking care of the street you live on, knowing your neighbors, making sure that you have relationships, that you're contributing to, whether it's safety or improvements. Ultimately, you see it, right, and there's a big argument, and is it causation or correlation, but it is certainly correlation. Crime rates are lower in neighborhoods with higher home ownership because of the way we fund education. Whether that's right or wrong, you can argue, but schools are better in neighborhoods with higher home ownership rates. And so ultimately there is a societal benefit here that contributes to the well-being of societies and communities, which is also why I think it's important that you have people like teachers and public sector employees and nurses and firefighters and creative artists living in your community, right? Which are folks who, they have solid incomes, but they don't have the ability to save, and if they don't have help from somewhere, they don't have the ability to buy homes today, right? And so what ends up happening is they end up getting squeezed out and commute in and live in other neighborhoods, not in the ones that, make healthy cities.
Yep. It's a huge problem in California. Super long commutes. Yep.
Yep.
Well, I want to go through your list. You listed 5 or 6 things that are kind of holding back the American housing market or causing this problem. The first one that was on the list was supply. I've had a bunch of people on the podcast, housing activists, the YIMBY group, who I'm sure you're familiar with up in San Francisco, and they have various degrees of optimism about whether or not anything can be done on supply. But my question to you is, do you think there's anything that can be done to improve the supply picture of housing in America?
Well, there's a ton of things we can do. I think the biggest challenge with all of them, whether it's, there's the regulatory side, there's the permitting, the ability and willingness of communities to build more. That's where it starts, right? There's the ability to finance and make a solid return on those investments, right? Because unless you have market rate capital coming in, you can't solve the problem at scale. But even if you solve all of those problems, and there's lots of good effort to solve those, the single biggest issue is time, right? And I've seen statistics where even if we increase the number of new units being built by 500,000 or 750 or 800,000 a year, it'll take us 10 plus years to build through or build enough to resolve the imbalance, right? The supply demand imbalance. And more people are coming to this country, right? The population continues to grow. I don't think that'll change anytime soon. And with that, right, we need more supply. And so the single biggest issue on the supply side, in my mind, is time. We're not going to solve this problem anytime soon. Right?
Yeah. It feels that way because like you get a peak year of production in America. Maybe you get 500,000 apartment buildings, and I think that new home construction is still under 1 million, right? Even in a good year at this point. And then last year, if you believe the numbers, it's hard to know what to believe, but 3 or 4 million people came to the United States, immigrants. That doesn't include any like natural population growth, people aging up and moving out of their parents' house. This is just like new people hitting so like the supply demand dynamic looks likely to go in the other direction
for the foreseeable future. I would agree with that. Yeah.
Yeah. Which has led a lot of the housing activists. What's been interesting about having these individuals on the show is many of them have gotten really so pessimistic that they're not quitting being housing activists, but they're looking to other things. They're looking to like election reform to try to do something even more radical. Like, can we get new people elected so that we can completely bypass the political corruption that prevents the development?
Yeah. I think the other thing that is important to keep in mind is it's not just the overall supply of housing units versus the demand of housing units. It is where are those homes being built, right?
Yeah.
Because we have a long-term secular trend towards moving into cities, moving into metro areas. That's where job creation happens, right? And that's where people want to be and need to be, right? Despite kind of working from home, which is a luxury that some of us and a lot of us have, at the end of the day, right, the economic activity is centered around a cluster of metro areas where you need housing, and you need housing within a reasonable commuting distance, right? And ideally close to the urban core. And so while there's lots of land and lots of potential supply in areas outside of those metro areas, it's in the metro areas that we really need housing.
Yep. And that's where the political environment is the worst, unfortunately.
Right,
Yeah.
right.
Okay, so supply, let's put that aside because we could waste the rest of our time talking about that and never get to it. Mortgages was your second point, and you made a really good point about how most likely scenario is mortgage rates are going to be closer to the historical average than they have been to the 0%, which quite frankly I benefited from in my generation.
Yeah,
my whole real estate career, interest rates were near zero, but now it's a whole new world. What did you find? You mentioned at the very beginning that you found some stuff in the data. Tell me more about that at your previous company. What did you find? And
yeah, so there's a couple of things going on, right? If you think about how do we make it easier for people to buy homes, there's kind of, if you take a step back and you say, well, what do you need to buy a house today traditionally? Well, you need decent credit, right? You need a decent FICO score, credit score, which means you need to prove over time that you can behave responsibly with your finances, right? If you can't pay your credit card or your car loan or your utilities on time, no one is going to lend you money, right, to buy a house. So first thing you need is reasonable credit. That's a behavioral thing. People are learning about it. You can learn about it, right? You can go to all sorts of websites. And at the end of the day, it's being a responsible consumer of financial services. Second, you need some amount of income, right? And that depends, right? If you want to buy a house in the middle of the country, you can have $50,000 in income and buy a house. If you want to buy a house in San Francisco, you probably need $500,000 in income, right? And you have everything in between. So you need some amount of income that's commensurate with house prices. And then you need the down payment, right, as a starting point, and that's savings, right? And again, that depends on house prices and all that. So back to what did we see in the mortgage data? Well, there's a couple of ways in solving this problem in which we can build, or where we can build products, lending products, or in our case, an equity investment product that lower the down payment hurdle and that lower the monthly payment hurdle. And I think a big part of that is the desire and willingness of the financial system to participate in that and be creative and lean into this. Now, the last time the financial system got creative and leaned into this, we created a big meltdown, right? The mortgage meltdown of 2008, 2009. And, the market suffered for a long time. And there's a bunch of underlying reasons, but one of them was, lack of underwriting standards and zero down mortgages to people who didn't have the income, didn't have the credit characteristics, right? Who then defaulted on those loans. And so what we've seen subsequently, and this is what you can see in the data, is kind of a reversion to much more conservatism. So lenders are looking for higher FICO scores. They're looking for higher down payments. And when you look at the data, average down payment has gone up. Average FICO score of the average mortgage borrower has gone up. So what that means is that if you don't have the down payment, you don't have the credit score, it's gotten harder and harder. And by and large, the mortgage market in the US is structured around mortgages that can be securitized and can be backed by the government. Fannie and Freddie as the two big ones. And that's fantastic, because what we have in the US is this market where the government guarantees interest rates, right? There's no other market where the government guarantees an interest rate on a mortgage for 30 years. In the US, we have that. The flip side of that is the government is very slow to innovate around products to help first-time buyers. So, can we come up with a longer-term mortgage, a 30, 40, 50, maybe 100-year mortgage? Can we come up with other products that lower the down payment hurdle? We haven't really done that because of this structure that we've built. So that's where we're innovating around the edges to say, well, let's rethink the structure and the product so that we can get more people into housing with a lower down payment, removing the moral hazard of a zero down mortgage, right? And potentially a lower monthly payment by compensating the investor, not just through an interest rate, but a rental income and home price appreciation, right? And by virtue of building that structure, we can lower the payment for the consumer to make it more affordable.
Okay. So the data was like in the aftermath of the great financial crisis, the mortgage industry got conservative, which makes sense. They went the other way. And so basically to get a house in that time period, you needed a bigger down payment, better FICO score, which means that it was just harder, even harder than the pre bubble days, I guess.
Correct. And so one of the things, and what I'm not saying is let's just lower the underwriting standards, because we've seen what happens when you do that. What I am advocating is let's rethink how the financing structure works itself to reduce some of the inherent risk of giving a big loan to someone who may not be able to pay it back. The other thing we saw in the data is that even for those people who were qualifying with mortgages, the win rate, i.e. the percentage of offers made by a first-time buyer that actually resulted in winning the home, that win rate went down significantly. So we did a deep dive analysis in Raleigh-Durham, the launch market, Research Triangle in North Carolina that we started in. And the win rate was somewhere around 1 in 8 to 1 in 10 offers for a first-time buyer that were actually accepted. And when you talk to first-time buyers, you hear this frustration, right? You go out, you look at a house, you see it on Zillow or Redfin or what have you. You go out, look at the open house, you make an offer, and you didn't win. And you do it again, and you do it again, and you do it again, right? And your realtor says, hang in there, you're doing the right thing. And then you're stretching a little more, and the next one you're making an offer 10 or 20,000 above asking, and you still don't win, right? Because we're in a competitive market, and you're competing, back to the prior point, against cash buyers and, professional investors who have other levers they can pull, faster closing, waiving inspections, writing a check on the spot. And so if you're a mortgage financed first time buyer with maybe an inspection contingency or another appraisal contingency, as a seller, you look at that and go, I'd rather go with the all cash offer, right? That's a better deal for me. And so the struggle that we saw in the data was just the win rate for first time buyers with these financing solutions that are out there is significantly lower.
Yeah.
And so a big benefit that we, through Ownify, provide to first time buyers is to say, we can make a cash offer on your behalf. We'll put you to the front of the line, right? And we're professional buyers who will be by your side working with you through that process. And so that provides a real benefit to folks struggling in the market.
Yeah. I didn't realize, I mean, I knew anecdotally that the win rate was bad, but I didn't realize it was that bad. 1 in 10 or 1 in 8 is really bad.
It is. And obviously it depends on the market, right?
Yeah.
But I think we've generally been in a seller's market, right? And we still are largely in a seller's market, right? Inventory is so reduced that sellers are still getting lots of offers. And so in that environment, it's hard for a first-time buyer to compete.
Yeah. What do you think? Because I've been tracking the buy to rent companies and the build to rent SFR companies. What's your take on that industry? And do you think they're going to get regulated out of existence before too long? What's your view?
I think there's a space for built to rent, right? And built to rent is, in a sense, a response to the struggle that buyers have, right? And the ability for families to live in a single family home in a nice neighborhood, right? Investors have responded to that by saying, we're going to build communities that have nice houses, all the amenities, right? But you have to rent it. You can't buy it, right? And so those built to rent communities are, in a sense, a response to the lack of affordability. Now, there's pressure on built to rent, and I think generally large single family rental operators to say, if you're buying up a meaningful chunk of the available inventory and you're not building new for sale inventory, you're just contributing to this problem that more and more people are forced to be renters, right? And so in individual communities, we've seen this introduction of some of the legislation. I don't think, quite frankly, that'll pass on a national level. But there is definitely some pushback. And as with a lot of politics, some of it is grandstanding for publicity and voters. But there is definitely pressure on some of these operators to provide more avenues and vehicles to ownership rather than just renting out more and more of the inventory.
Yeah, I feel like that industry, it kind of proves the point about the demand side of this picture. Like everybody wants to live in, not everyone, but this particular typology of housing, everyone basically, there's unlimited demand in this country based upon the supply. Yeah. And it's funny, I was talking to a friend of mine who does a lot of work advising large pension funds and government pools of capital from Asia. And their number one desire is exposure to the American single family market. And I get it. If you were someone with money in those jurisdictions, like owning American homes sounds amazing. Yeah. You get the backing of a relatively lawful property rights respecting country and incredible economics. If you look at the last 50 years, the home ownership economics are solid. You'd want to just hold them forever, basically. So I kind of get it.
But I'm with you. I mean, I think this is one of the ways in which we can attract capital, right? Is as an asset class, single family homes have always been lower risk, a good hedge against inflation. They can be income producing, right, if you structure it the right way. And there's a limited supply, back to the prior conversation, right? And in fact, a shortage of supply with an increasing demand side on the equation. So as a long-term structural investment, the asset class itself is very attractive, right?
Yeah, absolutely.
And so I think part of that, and so on our side, what we're doing on the one hand, we have the only in the consumer business and attracting customers. On the other side, we're attracting investors, and we're effectively allowing investors to co-invest in these homes, right, for long-term capital gains and passive income along the way. And so that is an attractive investment because of the attractiveness of the asset class.
Absolutely. And what's the vision? I know it's a relatively new venture, up and running. What is the grand vision for Ownify?
Yeah, I mean, the vision really is that long-term, we want to provide an alternative to how people buy houses in the US, right? As a new path to ownership that is different than the traditional mortgage debt-based path and better than renting, right? And so think of it as a path in between that gives you the lower entry cost, the certainty of payment, the certainty of earning equity, the ability to pick homes that are for sale, without the debt and the obligation to buy 100% of the home. And really this notion of, why couldn't you buy 20% or 30% or 50% of your home, or start with 2% and work your way up to 10%, right? That notion of fractional ownership around single family homes and real estate, I think has a lot of potential. And long-term, the vision for us is to provide that path, right, to first-time buyers in the majority of communities in the U.S.
And what do you think good looks like? Like the American homeownership rate is what? It's like 62 or something like that.
62, yeah.
What do you think? What should it be?
I think the high point we've seen was 65, 66% a number of years ago, right? If we can get back there, I think that's a win, right? I don't know if we can ever get it much beyond that. And I don't know that structurally, there's always going to be some number of people who are, who want to rent and who want that flexibility and, don't necessarily need to put down roots. So good is 66, 67, 68, maybe 70%. I think good really means that whoever wants to achieve ownership has a path to it, right?
Yeah.
And if you decide to live in New York City or San Francisco and you're renting because you're here for a number of years, that's perfectly fine, right? But for those folks who do want to achieve ownership, we should be able to create the market-based solution, right? And that, in my mind, is what good looks like.
Yeah. Amazing. I feel like I don't know if you all have thought about this, you probably have, but I feel like this equity model could apply in many circumstances, actually.
I hear this. Yes.
Yeah, cars, or even like I've talked to a lot of people who are passionate about like the democratization of finance and trying to give ordinary American households access to investments that they wouldn't get. And with real estate, like this strikes me that you could buy apartment buildings this way and give people access to those kind of investments. What is you're probably not going to focus on that now because you've got your mission, but what's your take on that?
I agree. I think there's opportunity around fractional ownership if you can structure it the right way. If you can build the legal infrastructure, right, and create the returns for investors or every participant, right? It's not just the investors, but it's every participant in the ecosystem. I hear this all the time. We're 100% focused on that homeownership journey, right, and enabling that. And I think there's a ton of work and a lot of ground to be covered here. But that doesn't mean that we won't, tackle multifamily at some point or potentially commercial, right, with the right structure.
Yeah.
But I think for the foreseeable future, it's helping that first-time buyer, right, get their foot in the door.
Yeah, and that's a huge. I don't know what the number is, but it's millions of customers who are just waiting.
So I'll tell you what the number is, right? For the next 10 years, there's about 18 million Gen Z, millennial, first-time buyers that are looking to get into the market, right?
Yeah.
And simple math is half of them need help around down payment and affordability, right? So that's somewhere around 900,000, maybe 1 million people a year. So if we can help, 1% of them, and then 2%, and then 5%, and potentially 10%, that would be a huge win and a massive, massive opportunity for us.
Yeah. Well, Frank, this has been a really fun conversation. I'm pulling for you because I really believe in your mission.
Thank you.
I feel like it's so crucial for this country that homeownership is viable for as many people as possible. And I really like the innovation that you have. I like that it's not debt-based. I think that's unique from what I can tell and important because the debt can get you in trouble. And so I really I'm excited, and I'll make sure everybody knows where to find you all if they are interested in following up in any way. But thanks
Please
for
do.
coming on the show. Yeah.
Thanks for having me, Nick. Really appreciate it.